Hi, thanks so much for joining in. You're watching the Mutual Fund Show on BQ Prime. My name is Alex Matthew. Now, usually we talk about trends in the mutual fund industry to kind of help you make the investment decisions that you need to make. And generally, when we need to get certain research about fund flows and about portfolio construction, we go to the guests that I have on this particular show, and that's Morningstar. I'm joined by Kaustubh Belapurkar as well as Himanshu Srivastava. Thank you so much, gentlemen, for taking the time. And the topic that I've discussed with you for this week's episode has to do with cash, because we've seen considerable investment by retail investors into mutual funds over the past several months. And at the same time, you've seen domestic institutions that have been deploying at a time when foreign institutions have been exiting, particularly over the last 3 months. I asked you to look at the equity mutual funds and talk about the amount of cash that they're holding. How much is it and what does that tell you? I'll start with you, Kaustubh.
Sure, Alex. So I think that's a very interesting data point to look at because it gives you a pulse of what's really happening, what managers, professional money managers are thinking. And I think the one thing we've seen, and just to answer that question in terms of numbers, I think equity mutual funds in total are holding about 90,000 crores in cash right now. Obviously, at any point of time, you would see a reasonable amount of cash because there's always money, dry powder to deploy. But I think over the last 6 months, this number has inched up. So I think that's a pretty sizable amount of sort of money that's lying.
That is at the end of September.
Yeah, that's right. Yeah. So I think it's a pretty reasonable number to look at in terms of to deploy from a manager's perspective. I think what managers will look to do, not go the whole hog immediately. I mean, there's obviously a lot of moving parts right now, be it locally or globally in terms of obviously geopolitics and other things. So they're going to take some time to really do that. And especially on when you think about small and mid caps. And we'll talk
about that. Yeah. If we're talking about 90,000 in the context of equity mutual funds, correct me if I'm wrong, we're talking about close to 5% or thereabouts.
Yeah.
So if we're talking about cash levels of about 5%, how does that compare to periods in the past where you've seen slightly elevated? And I would argue that if you're talking about 5%, that is relatively elevated.
Right. So in the past, what we have seen is, if you look at the market, how the market moves in cycles. So there have been cycles when the cash allocation suddenly goes up, and there have been cycles when the cash allocation suddenly moves down. It's largely when they are if managers are not able to find enough opportunity in the market, say a stretched valuation, that is when we see cash levels going up in the mid and small cap segment. Normally, what also happens is about the liquidity. If the portfolio has grown quite significantly, if the size of the portfolio is big, deploying that kind of a cash immediately becomes a challenge. These are also some of the scenarios where we see that the cash allocation of fund might move up. Then there are certain funds which traditionally maintain a relatively higher degree of cash for an elongated period of time. Obviously, one of the reasons is not able to find enough opportunity in the market, which is in line with their investment style. But historically, I think it's very difficult to say that cash levels were higher or lower earlier. I think it depends on which part of the market cycle we are in, and at that point of time where the cash levels should lie.
If you splice the data, and you were pointing to the fact that mid and small caps or funds are currently holding elevated amounts of cash, how much? And the reason is seemingly very obvious to us sitting here, but if you can break that down.
So I think, I haven't looked at the granular numbers by fund, but I think traditionally what we've seen in terms of just directionally, a lot of mid and small caps are probably holding much more than that of 5%. Because remember, when you have an average of 5%, a lot of large cap managers traditionally would typically be almost fully invested, maybe 2% of cash. And there are several reasons for that. I think Himanshu alluded to one, that valuations are obviously a little expensive. Also, the other thing that we've seen in terms of flows, right? Investor money has gravitated towards small and mid caps. And it's not just been through your SIPs, which managers are typically geared for, but there's a lot of fresh money coming. And managers also being much more prudent, which is right? Because you don't want to be buying anything and everything. So you take your time, deploy that cash more judiciously. And that may not necessarily only be a function of what's happening in the market, but just because obviously you would want to move the counter slowly and things like that. So I think that's what is also driving some. I would say, I wouldn't say it's extremely elevated, but it's probably higher than what we've seen in in the recent years.
Okay. If we're talking about portfolio construction, and obviously you do multiple research studies across various funds, what, according to you, are the most interesting trends that you're picking up when you study fund manager behavior over the last few months?
Over the last few months, if you look at certain portfolios, especially if you're talking about mid and small cap segment, and if I have to specifically talk about small cap segment, I have seen that the number of stocks in the portfolio is gradually going up. That could be slightly because of capacity constraint, or you're getting a lot of flows. And it's not really bad unless and until it reaches to a certain extent where you feel that it becomes unmanageable. But at the same time, if for a fund manager, it's also important to maintain liquidity in the portfolio. So having a very top concentrated portfolio or high allocation to one or two stocks or maybe three stocks, we know that liquidity in the small cap segment could be very challenging when the tide is not in its favor. So what managers are doing is to incorporate these extensive flows that they are coming into their funds. I think what they are doing is they are expanding the number of stocks in the portfolio so that, one, they maintain liquidity, there is enough diversity, so they are slightly on the safer side at this point in time. This is one of the trends that we have picked in the recent times. If Kaustubh can.
No, absolutely. And I think that also leads into the other factor that a lot of small cap funds are soft closing also. Yeah. Because they acknowledge that capacity can potentially be, and which is a great thing to do, right? Because
it's healthy.
It's healthy. It's in the best interest of investors. It's probably the worst, if you think of it as a businessman, it's the worst thing to do, to turn away money when everyone's trying to, come to you, right? But that's probably the most prudent thing to do for an investor's perspective, because you're not finding maybe the most amount of opportunities in that space. Valuations are expensive, or assets are ballooned, and also somewhere I think just setting the investor expectation also look, things have. It's not going to be the case just going forward every year and year, because investors tend to gravitate towards short-term returns, right? And that's where a lot of the money is coming in. So I think just setting the context also for the investors is important, which is happening, which is great.
The other segment that we discussed, Kaustubh, is the allocation segment, which is the hybrid segment, where fund managers have the ability to change their allocations of their funds either towards equity when it looks attractive, or towards fixed income when it is not, or when fixed income is attractive, which seems to be the case right now. What are the trends that you're seeing in the portfolio construction there?
So that's actually very interesting. So we looked at 3-year average net equity exposure, and typically two categories where you would see a fair bit of flex in the equity exposure, obviously your balance advantage funds and a little bit on the multi-asset side. And I think what we're seeing is that the current net equity exposures are actually very close to 3-year averages, which is interesting because, and maybe the needle might move in the next few months, where especially the PAFs, which are, a lot of them run on, say, valuation models and things like that, might look to reduce some exposure. Also because, fixed income yields are looking great, right?
So when you say that they're at the 3-year average, they are slightly elevated and they could go down going forward, is what you're saying. So there could be a little bit of selling that comes in there when I think fund managers decided to take some profit off the table. But what is the size that we're talking about, Kaustubh? In terms of the size of the segment, I'm guessing it has grown in the recent past. But
if my memory serves me right, almost about 3 lakh crores in assets between these two categories. And probably, the cash levels, net equity exposure can range anywhere between 50 to 60% with a lot of these strategies. You take off 5% to the math, you won't see a sharp drop, but there could be some.
I was going to come to that. Do you generally see very sharp swings in portfolio management? No, it's a gradual shift over a period of time. And in your experience, what kind of period do you see these shifts take place in?
These are periods when you see fixed income giving slightly better, or I would rather put it like that, risk reward profile is better in the fixed income segment than on the equity side.
Which is the case right now.
This is the case right now. You see a lot of geopolitical tension, or what is happening globally does impact Indian markets. Obviously, Indian market has not been that impacted because we are getting a lot of flows from the DI investors. But at the same point in time, you can never be very sure as to when the tide could turn. These are some of the perfect scenarios where a manager in the hybrid space have the flexibility to use that flex to safeguard the fund, move slightly away from risky assets like equities, and expand some exposure or have some exposure allocated to fixed income. Okay. So I think this is the perfect time when we can expect managers to do that.
So call to action moment, right? Because the objective of the show is to help you make decisions. You've probably got a lot of SIPs running, potentially in mid cap and small cap as well. And you probably make lump sum investments into these schemes over a period of time. So the question, Kaustubh, and then I'll come to you as well, is how do you adjust that? You're seeing some people talk about valuations being stretched, particularly in the broader end of the spectrum. Fund managers are understandably holding cash. Do you take a call to reduce SIPs, or do you keep it going, saying that it doesn't really matter you're looking at the next 5 years anyway?
Yeah, that's a very important point. That with SIPs, I mean, the whole intention is you do nothing about it, right? And that's how it should be, because the whole concept of autopilot investing is exactly that you're not trying to use an override function unless something has dramatically changed in the world, which is not, right? So the whole idea is that you continue with that, but also set your expectations correctly, because I think what I was alluding to earlier is that a lot of investors get swayed by recent returns, and they extrapolate that this is what I'm going to get in the future, right? And that's not going to be the case. So even when you're coming in, even through the SIP route, be ready for drawdowns or negative periods, probably prolonged for a period of time. I mean, we've seen that happen, especially in the small and mid cap space. So I think that's something you need to be behaviorally attuned to. Obviously, if you have the right investing horizon, which you've obviously done the math when you invested in a segment like small and mid caps, just stay the course. But there'll be volatility in between, maybe heightened potentially. Don't worry about it. I mean, yeah.
And that's great advice to carry that forward, and to say that over the last 9 months or so, you've seen a sharp outperformance by small and mid caps. And even though you've had actively managed funds underperform, especially in the small cap category, the benchmark, you've still seen significant double-digit returns, which would have skewed portfolios as well. Right. Is this the moment to rebalance if you've seen that skew?
So obviously, if your asset allocation requires you to be, say, X% in small and mid cap, and that X% has become X plus 5% or 10%, then obviously this is a time when you can rebalance your portfolio. You should be looking at doing that. The idea is, obviously, you should balance that kind of portfolio, but it should not be because of some fear or something. It should be because that is the requirement of your asset allocation. Ideally, if you are investing and if it's your asset allocation suggests so, you should continue to stay the course, as Kaustubh mentioned, because that is what the long-term investing is all about. The small caps over the recent time we have seen has been very, very volatile. We can see sharp surge, sharp drawdowns, right? To ride through that cycle, the idea is to stay put.
No, absolutely. You wanted to add?
Yeah, I was just saying, like Himanshu rightly said, it's never a 0-1 game, right? Yeah. It's always making those graded adjustments to your portfolio. And the same thing which an allocation fund would do, that, they're never going zero in equity, for instance. They'll always move within a band, because, equity, small and mid caps are great long-term wealth creators. But you need to stay the course. So you only make those
and you don't only invest in small and mid.
Exactly.
Because they're the flavor of the season. But gentlemen, great conversation, and I think insightful as well. Viewers will definitely have benefited from it. Thank you so much for joining.
Thank you.
And viewers, there you have it. It's said often in various walks of life, don't put all your eggs in one basket. There are various other sayings that you can take from this, but then the bottom line, of course, is to be pragmatic and be sensible in the decisions that you're making. Hopefully this conversation has helped you do some of that. Do stay tuned, lots more coming up on BQ Prime.